Hello, everyone. Thank you very much for tuning in. And today you are going to benefit a lot in less than 45 minutes. And this is all about bookkeeping and training. And you'll be able to apply what I'm going to discuss with you in personal business projects, the company that you're working for, to add value in every part of the any business related aspect which pass through your hands. So this is our today's topic that we want to discuss about how to know 85% basics of bookkeeping and accounting in less than 45 minutes. And this video is meant for those who needs to understand the business information, who needs to understand the importance of records, those who needs to understand why their business fails, those people who needs to understand to what extent they will be able to adjust certain attributes or certain aspects of their business in order for them to continue making profit and also understands every aspect of business activities. My name is Samuel from Chinaki Global, and I have more than 10 years experience in various industries, which includes teaching, risk assessing, also finance and accounting. So I'm also a certified Zero advisor. This is an accounting software which can do all the bookkeeping processes of SMEs. So I have a business partnership status program with them, and I'll be able to advise clients to set up and also to do the bookkeeping for them remotely. So without wasting time, this is what we are expecting to understand. So the first aspect, we shall look on the various types of the source documents that we have and their importance. Then from there, we shall also have a look on books of prime entry and their types and also the importance, why they are relevant. We shall proceed to the next aspect where we want to look various types of the general ledger accounts where the accounting information are recorded by the bookkeepers or by whoever who is doing the records of your business, right? Then we shall also look on the trial balance, and most of the people, they only knows about one trial balance, but I shall going to add more different types of trial balance that we prepare for various reasons. Then lastly, we shall talk about different types of reports. This may include financial reports, management reports, and how this information can be used to come up with the dashboards, which can be used to measure the performance of the business within a short space of time. So let's dive into the main today's business. So on the source documents, these are the evidence of the business activities, right? So most of the people, they might need to understand, okay, when we're talking about source documents, is it something that we can get from somewhere else? Or is it, do we have what we can keep as source documents and other documents that we keep within our business are not relevant? You might have got different questions that you have, but any business transaction or any business activity that we have, we need to have a supporting document. This document, it can be in soft copy. It means you may not be able to touch it, but you'll be able to see it through digital platforms that we have, right? Or else it can be a hard copy, something that you can touch and feel, right? Be it a quotation, an invoice, or a purchase order, or a purchase requisition statements from the bank, statements from the suppliers, or any receipts that you get after buying business items, or any credit notes or debit notes. These are different types of the source documents which are used by various businesses in order for them to show the evidence of the transactions. So it is very important to make sure that all these different types of source documents are kept safely for a period of more than 5 years, right? Why 5 years? Our tax authorities, most of the tax authorities, they need these documents to be kept for at least 5 years, right? The importance of keeping these documents, it acts as a point of reference in tax disputes, or sometimes you might have got anything which requires some supporting documents, be it by auditors or by other authorities which governs the operations of your business as an SME. So it is very advisable to keep or to store these supporting documents either as hard copies. And thank you for the technological advancement. These source documents can be kept as soft copies or on each and every transaction. You are going to have a look on this one on my next video when I'll be discussing about Zero and how we'll be able to assist you in keeping your source documents in the cloud, right? Then this is the first part of the bookkeeping, about understanding the business activities and in source documents which are involved. Then after having the source documents, the next step that we want to look at, we now need to record. So whenever we are recording our business transactions, first of all, we need to understand that we have what we call books of prime entry. Books of prime entries are the various books where we record our daily activities, which happens within our business, right? At the end of each and every day, we summarize the totals that we have recorded in the books of prime entry and complete what we call the general ledgers using the double entry, right? So we have various types of books of prime entry, and this include sales day book. This is where we record most of our credit sales that we have. So we just record them during the day. Then at the end of the day, we summarize, we get the totals. Then the totals that we have, that is the figure that we're supposed to use to complete a double entry, right? So we shall talk about the double entry soon, okay? So we also have a purchase day book. This is related to the credit purchases. Then we also have a cash book. Within the cash book, we record both bank transactions and also the paid cash transactions, right? So we have two columns. One column, it actually indicates the bank transaction. Then the other one is also indicating the paid cash, right? So we shall also discuss more in the next videos about each and every aspect of these different types of the prime books of entry and how we're supposed to do their recordings, okay? Right? So sometimes we might also sell some goods to the customers, and for some reasons, other goods might be retained back to our business. These goods needs to be recorded in what we call the sales returns daybook or returns inward daybooks, right? Then if our business returns some of the goods to the suppliers, then we need to return these goods in what we call purchase returns daybook, right? Then sometimes we might also have other transactions which are not recorded in one of 1 to 6 daybooks I've discussed with you. They're supposed to be recorded in what we call the journals, right? Okay. So let's quickly have a look on general ledgers. Okay. So after summarizing the totals from the day books or the books of prime entries on the daily basis, the totals needs to be recorded in general ledgers. A general ledger, this is just a document where we record all the business transactions, right? In the double entry, okay? So let's say a general ledger is just a book like this one. This is just a book I'm holding, and I can say this is the general ledger. So from within this book, each and every page, it may represent aspect of business activity where we are recording each and every type of business activity. And each page may represent a ledger, right? A general ledger is that just the whole book. Then each page that we have in this book is a ledger. So we might also give it a name. We can call it an expense, right? Or rent, depreciation. The other one, we can call it sales. The other one, we can call it a discount received, a discount allowed. So in simple terms or in layman terms, a general ledger is just the chart of accounts. To those people who are using the accounting software to do their bookkeeping and accounting processes, a chart account can be used as alternative name for general ledger, right? Okay, so we have different types of general ledger, but this general ledger can be classified into two. We have what we call the personal ledgers, right? And also the impersonal ledgers. So from the word personal, it means they are related to what? They are related to the personal, right? Personal information. We are recording the information related to the accounts receivables, accounts payables. Okay, when we are saying accounts payables, this is the information related to the individual or company that supplies us with goods and services, right? On credit. Okay, then accounts receivables, this is our credit customers information, right? So those ledgers, we are recording this information, they falls under personal ledgers. Okay, so we also have what we call impersonal ledgers. So this one are now other ledgers apart from the person, right? Okay, so the first one is real general ledger. This actually refers to um, the ledger where we record those transactions, right? That we're supposed to have within our business at the end of the period, and we are not expecting to close the books or to close the ledger, right? We just want to carry on with these transactions. For instance, the assets, the fixed assets of the business. If we have a motor vehicle that we have within our business, we expect to use this motor vehicle from month 1, month 2, and also year 1, year 2, etc., going forward. So the information related to the costs, related to the depreciation of the vehicles needs to be recorded in ledgers, which can be grouped into a real account or real ledger accounts. Okay, right? Then we also need to have a look on the private ledger, right? On the private ledger, we are actually talking about those sensitive business information that is supposed to be kept private or in custodian, under the custodian of a trustworthy and someone who will be able to keep the confidential information of the individuals. For instance, salaries, right? Also capital accounts of the shareholders, dividends accounts of the shareholders, right? These information are very sensitive and they're supposed to be kept private in what we can classify as the private ledgers. Okay, then we also have the nominal ledger. Under the nominal ledger, this is where we can record only the other transactions that we normally have on the daily basis, be it different types of the expenses that we have, and also the sales that we have. Okay, so most of the items that we record in the nominal and ledger, they are normally recorded in the profit and loss account. Okay, right? And most of the items that we record in the real ledger accounts are recorded in the balance sheet. We shall talk more as we proceed. Okay, so let's quickly have a look on the just overview on how are we supposed to complete this ledger accounts. Okay, so we want to start with the accounting equation. Accounting equation, what it means here is that whatever we are giving, right, there's also a part which is receiving. Okay, right? So if we are having our accounting equation as assets equals to liabilities plus capital, right? Whatever changes which happens on assets, right? It still needs to keep this accounting equation equal, right? What we have on the left hand side and also the right hand side of our equal sign needs to match in terms of the totals, right? So this is the golden rule that you're supposed to know as a business owner, as an SMEs, right? So you might also need to know, okay, which account are we supposed to debit and which account are we supposed to credit when it increase, right? I've just indicated some T accounts so that I can give you an overview of what happens when we are dealing with assets. Okay, assets, these are the items that we use within our business, right, with intention of generating the profits or generating revenue for the business. Okay, So they can also be classified into short-term and long-term. Okay, right? For instance, those assets that you're expected to use for more than 12 months, they are long-term. Those we are expecting to use for less than 12 months, they are short-term assets. Okay, so whenever our assets increases, it means we have bought new assets that we brought into the business, right? Or we have hired the new assets either under the lease agreement, and we need to record them in our books. Okay, so if our assets are increasing, we need to debit, right? Our assets. If our assets are decreasing, we need to credit. Our assets can decrease when we are selling part of our assets. Okay, right? Be it motor vehicle, be it inventory, right? Okay, or be it a payment from the bank, we are reducing our assets. Okay, right? Expenses. This refers to the anything that we pay with intention of operating our day-to-day activities, right, of our business. Okay, right? We have a certain way which the IFRS International Financial Standard Reporting Standards, right, refers as their definition. Okay, but I'm actually expressing it to the layman terms so that whoever who is running a business, anyone who is a non-accountant will be able to understand the meaning of the expenses, right? And these expenses are recorded in the same way we are recording our assets. When they are increasing, we need to debit. When they are decreasing, we need to credit, right? Sometimes in the business which is operated by one person is called a sole trader. Then the sole trader might take goods from the business for personal use. That is called drawing. Someone is drawing either goods or can drawing cash from the business for personal use. And such information needs to be recorded in the what? In the records, drawings account. So when the drawings are increasing, we need to debit. When the drawings are decreasing, we need to credit. Okay, right? Then we also have liabilities. Liabilities, these are short-term or long-term obligations which are supposed to be paid by the business as they fall due, right? They may constitute some loans or overdrafts, right? Or creditors, okay? But these items, when we are increasing our liabilities, we need to credit, right? We need to credit our general ledger, right? When we are reducing by paying out, okay, we need to debit, okay? Then for the income, be it the credit or the cash revenues we are receiving, when our income is increasing, we need to credit, right? Our income account, right? Then when our income decreases, we need to debit. Then we also need to understand that we have capital accounts where we are recording the information of the either money or items introduced into the business by the owners of the business. They are recorded in what we call the capital accounts, right? But in companies can be specifically be defined as the share capital accounts or reserves, share reserves accounts, right? Or can be recorded as the equity account. These names can be used interchangeably depending with the type of organization that we are discussing about. Okay, right? So this is just the overview of what? Of the different types of entries in the general ledger accounts. Okay, right? So let's proceed back to the to our steps. Okay, so having our records in the general ledger, it means that whenever the transaction happens, we are recording it in general ledger. And if you are doing it manually, this can be done either as batch or it can be done as real, right? Whenever a transaction happens, then everything can be recorded, can be updated in the general ledgers. Okay, right? So having this general ledger, we now need to make sure that we have recorded everything, right? We have recorded everything in our general ledger. Then we summarize everything in our general ledger at the end of the month or at the end of a period that we want to analyze our information at, right? Then after adding the totals, we come up with the closing balances that we're supposed to transfer to the what? To the trial balance. But before we do the trial balance, we also need to do a bit of the reconciliation so that we'll make sure that we have the correct information within our records, right? So we have different types of reconciliation that we can do. We have what we call the bank reconciliations, right? Where we are matching the information that we have within our cash books and the information that we have within our bank account, right? So if it happened for us to have any discrepancies, we trace down and find out why we ended up the discrepancy, then we resolve accordingly, right? But most of the discrepancies, it might be due to the either omissions, right? Some errors which happens either at the bank or which happens within our books as we were recording, right? Or we have completely omitted some of the information, right? So we can have bank reconciliation. We can also have pet cash reconciliations. With our cashier, we need to understand how much cash at hand that we have at the end of the day, or at the end of the week, or at the end of the month, okay? Right? Or before introducing more pet cash within our business. When I'm saying pet cash, this is just a little amount that we keep within our business for an ad hoc or sundry, or those little items that we buy for operating our business with, be it some lights, be it some bond paper, or anything which is just small, right? Then some reconciliations related to the inventories, depending with the type of business that we are dealing with, right? We need to make sure that we are having some reconciliations, okay, right? And this reconciliation might also include the inventories so that we'll have the correct stock. So the inventory, it can be for the work in progress, or for the finished goods, right? Or for the raw materials, depending with the type of organization that we are dealing with. Okay, then the other aspect that we can also have some reconciliation with are the credit customers and also the credit suppliers. We need to match and make sure that we are on the same page before we transfer our totals to the trial balance, right? Under the payroll, we also need to have some reconciliation so that we make sure that we have the correct payroll and also the ultimate tax returns which are paid from the payrolls, which may include pay as you earn, UIF, and skills development levy, NASA, depending with the country that we are dealing with. Okay, so we have a lot of things which are related to the payroll. So we need to make sure that whatever we are paying out from the payroll is making sense, is accurate, free from errors, right? Fixed assets, the business property that we have, we also need to have some reconciliations and make sure that we have accurate information. Then sometimes we might also need to have some provisions, right? These are amounts that we set aside without a substantial accuracy, okay? So be it of the provision for bad and doubtful debts, also the depreciation, right? Also, sometimes we might have got some court cases that we might that we are handling, and if we are also expecting to incur some losses on that, we can provide some losses, some provisions. We set aside money to cater for that as part of the provisions. Okay, right? So having done all the reconciliation, we can take our totals from the general ledger to the trial balance. So when we are in the trial balance, we need to understand that the first trial balance that we prepare, it is called the unadjusted trial balance. Okay, so an unadjusted trial balance is actually the first trial balance that we prepare from the totals we are getting from the what? From the general ledgers, right? It is called unadjusted because we haven't adjusted month-end or year-end adjustments, right? This may include depreciation, right? This may include depreciation, okay? Provisions, different types of provisions, or all those non-cash items which are supposed to be adjusted at month-end, okay? Right? So having our adjusted trial balance in place, we can now proceed to the what? To the preparation of the financial statements. And this is now part of the what? Of the reporting. Okay, right? So under the reports, we have what we call the management reports and also the financial statements. Okay. we can make use of the same financial reports, right, under management. But under management, we are now dealing with the detailed information. But under financial reports, we are dealing with the summarized information. Okay. So we have different types of the financial reports, right, or financial statements. We have what we call the trading profit and loss account, which can also be called the statement of comprehensive income, right? Then a statement of changes in equity, right? We also have the balance sheet. Then we also have the cash flow statement. And lastly, we have the notes and disclosures, right? So whenever we are having these financial statements, it's not just a matter of having them in our books without getting value out of them. So as the business owner, you need to understand the meaning behind the figures that we have in each and every statement that we have, right? This can also help you to know what areas are you supposed to leverage, what areas are you supposed to focus on in order for you to maximize or to optimize your profit, or to optimize the utilization of your resources that you have, right? Okay, right. So let me quickly go to the samples of these financial statements so that you'll be able to know how they are looks like. Okay, so this is the example of the what of the trial balance, right? This is the trial balance. You can see that the trial balance, it has a column which indicates the accounting description, right? And also a column for debit and also a column for credit entries. So all of this information needs to balance, right? The totals that we have down here at the end of our trial balance, it needs to reflect that our trial balance has balanced, right? The debit amount and the credit amount, it needs to be equal. So sometimes our trial balance can balance while it is still have some errors. I'm actually going to make a different video discussing about certain reasons why our trial balance may still balance, yet we have some errors. For instance, if we completely omitted a transaction from our books, our trial balance can still balance, right? But our information is incorrect. Okay, so we shall discuss a little bit more about that one in the future videos. Right. So after having our trial balance, we use that information to prepare what we call a profit and loss account. This is an example of the profit and loss account, right? This is a statement of comprehensive income and the retained earnings for the year ended this date. Okay. So this is just a comparison. I was just illustrating two financial periods, right? We have year one and also year two. Okay, and also another column for notes. These notes these are references which can take us to the notes and the disclosures where we have done some calculations of these figures. Okay, right? So the first section of the profit and loss, we are talking about the revenues, the income that we have received, and also the total cost, right? That we have recorded, so that we'll be able to calculate our gross profit from the trading activities. So sometimes we might also have other non-trading activities which can also give us income to our business. This is called other incomes. Then we can record them, we can add them to gross profit before we subtract all the operating expenses that we have incurred when operating our business. So the list is endless. Okay, these are just examples of expenses that we are deducting so that we can able to get our profit before interest and tax. Then we now need to deduct our finance cost. If we are using borrowed funds, we need to pay some interest, right? Interest on loan. This is part of the finance cost. We're supposed to be deducted from these figures so that we'll be able to get our amount before calculation of income tax. Then we can calculate our income tax as a percentage of our what? Of our profit or loss before tax. Okay, right? Then we can also now apply our funds into various aspects. For instance, we now need to pay out some dividends or rewards to the shareholders. Then we now need to deduct. For instance, here you are seeing 150, you are seeing 100. This is the amount or the rewards paid to the shareholders or to the owners of the business in the form of dividends. Then the balance, it was retained into the business, right? Okay, right? So after having these figures, the retained earnings, we can now proceed to the statement of changes in equity, where we can record the movements which happens within our share capital and equity, right? Share capital and reserves, okay? These are terms that we are using when we are dealing with the companies. But when we are dealing with the sole trader businesses, we can just say the capital, right? What is happening? What is additional capital introduced by the owners? What was the balance at the beginning of the period? What was the amount retained into the business from the profit we have realized during the current financial year, right? We will be adding everything, okay? Right? Then sometimes if we have paid dividends, we also divide. Then if we have issued additional shares, we are actually adding this information into our equity and share capitals, right? So that by the end of the period, be it end of the month or end of the financial period, we are having our what? Our closing balances. This is our closing balances that we have, and we need to take these closing balances to the balance sheet. Our balance sheet can also be called a statement of financial position, right? This is just the snapshot of our business at a specific date, right? Okay, and it indicates the net worth of our business, right? In terms of what is the different types of the assets that we have, long-term and short-term, and also tangible assets and intangible assets, and also what is the equity, share capital, reserves, and reserves that we have, right? The liabilities, both short-term and long-term liabilities, what is the amount that we have? So the figures that we have from the statement of financial position and also from the profit and loss can also be used to calculate our cash flow statements, right? So a cash flow statement, this is a statement which indicates the receipts and payments of the business at a specific period of time, right? And it only indicates the cash movement, right? So this is the true reflection of measuring our liquidity position or our ability to finance the short-term obligations as they fall due. Okay, so this is our cash flow statement, right? It has some various informations, and also there is a difference. There are two different methods that we can use to come up with our cash flow statement, but we shall discuss with them in our separate videos. Okay, then we also have what we call notes and disclosures. Notes and disclosures, this actually indicates an additional information that we use to support our our financial statements. Okay, so these are detailed calculations of our depreciation, or how we have calculated the figures that we have included in either profit and loss, or in the balance sheet, or in the cash flow statements. So we have different types of of notes, and this is a requirement, and they give more insights to the users of this financial information, right? So after having this financial information, if we are preparing this financial information for reporting purposes, right? This is what we're supposed to include. If we are preparing this information for management purposes, we need to do an extra aspect of coming up with some analysis, some ratio analysis, and also we can come up with the dashboards that we can use to indicate our information in the in the business for decision making purposes. Okay, right? So let's quickly have a summary of the difference between a bookkeeping and accounting cycles. This can also give you a clear picture of what is the roadmap we're supposed to follow when we are dealing with our accounting and management information. So you are seeing that we have 6 steps. From the previous slides, we have 6 steps. So the first step, we have activities of the business and source documents that we have. After having this one, we need to record them in the books of prime entry using journals, right? Then we also need to summarize these journals and also the books of prime entry, and check the totals, record them in the general ledger. Then from the general ledger, we need to make sure that we have reconciled and take the totals at the end of the month or end of the financial year, right? and prepare the what? The trial balance. Then under the trial balance, we have what? We have the adjusted trial balance. Then the information from the trial balance can be used to prepare different types of what? Of reports, right? So from point number 1 to point number 5, right? We call this information bookkeeping cycle. So whoever who is dealing with this information is called a bookkeeper, right? Okay. Then from the first activity to the last activity, right? It is called an accounting cycle, right? So it is good for every business owner, for an SMEs to know and understand what is the difference between a bookkeeping and accounting cycle, right? And also to know why we are preparing the management reports and also various types of the financial statements. Okay, right? So having this in place, it can also assist you to know what areas are you supposed to focus on, what information are you supposed to include in the what? In your reports for the business analysis purposes, right? So we've come to the end of our session, and if you like this video, just give it a thumb up so that I'll be able to make more videos like this. And if you have a burning business that you have and you're facing some challenges on how to reduce cost or how to understand or to come up with the performance indicators, feel free to reach us. Thank you.